Welcome to today's webcast on tax reform and R&D incentives. My name is Travis Riley.
I am a senior manager here at Moss Adams. I've been with the firm for over 11 years, and I have been doing nothing but R&D credits that entire time. I work with a lot of companies in various industries, including a lot of life science, technology, software companies, and I'm in Northern California and cover the Northern California region. And happy to be here talking to you today. So I know that tax reform, it's definitely a hot topic right now. I know it's at the top of everyone's mind. I know it's a lot for everybody to digest. But I just want to start off by telling you that the R&D tax credit was retained. Just want to get that out of the way. But we're still getting a lot of calls, getting a lot of emails, a lot of people asking, hey, what's going to happen with my R&D credit? I was reading the news the other day, heard it might go away, heard you can't deduct R&D costs anymore, sky is falling. Is any of this stuff true? Those are the kind of questions I'm getting. So I'm going to do my best to answer all of these questions, and I'm going to get into specifics about exactly what changed, what stayed the same, and how all this might impact your bottom line if you're a company that's performing research and development. So what did change? And before we get into it, all of the changes that we're about to talk about apply to the 2018 tax year. So if you're currently preparing your 2017 return, just keep in mind that we're still operating under all of the prior rules. But we're going to start off with some good news here. And the good news is elimination of the corporate AMT. If you're not familiar with corporate AMT, it was essentially a rule. It said, hey, you can have all the credits and deductions in the world, but if you're otherwise profitable, then there's a minimum amount of tax that the federal government wants you to pay. Bit of an oversimplification here, and it really depended on the nature of your income and deductions, but the minimum rate of tax was set at 20% under the previous law. So the problem with that, and this created quite a stir in the Senate bill, if you were paying attention. Problem with that is that the new corporate tax rate was also initially set to 20%. Now, if the corporate rate is set at 20% and AMT rate is also set at 20%, you can see how this creates some problems for companies that may claim an R&D credit. So retaining the corporate AMT would have made R&D credits essentially worthless. I know that received a lot of press coverage, front page of the Wall Street Journal, but long story short here is that the corporate rate was set to 21% in the final bill, and the corporate AMT was eliminated completely. So good news there. However, just because the corporate AMT rate was eliminated doesn't mean that you'll be able to use R&D credits to lower your taxes all the way down to zero. And reason for that is because of this other rule that was not eliminated, and we call this other rule the 25-25 limitation. And the way this limitation works is your credit cannot exceed the excess of net income tax over 25% of the tax that exceeds $25,000. I know that's a mouthful, but another way to look at this is that you'll be able to offset your first $25,000 in tax liability and then 75% of your tax liability thereafter. So, for example, if you have a $100,000 R&D credit and $100,000 in tax liability, you'd be able to use $81,250 in credits in the current year. Then if you the leftover credit, you carry that back 1 year and you carry it forward 20. So this 25-25 limitation is just something we want to make sure you're aware of because it might affect a lot of taxpayers on a go-forward basis. So what else changed? A little bit of mixed news here for taxpayers who pay AMT at the individual level. The individual AMT it's a big deal for taxpayers that receive R&D credits from their pass-through businesses. So we're talking about S-corps, partnerships, maybe sole proprietorships. Under the previous law, the individual AMT hit almost 60% of taxpayers making between $200,000 and $500,000 a year. Now, under the new law, the individual AMT was retained, but it was scaled back by increasing exemptions and phase-outs for the next 9 years. So the entire idea here, the whole idea is that the AMT, the individual AMT, should hit fewer people in that income range. So how much did they scale it back? Well, the exemption amounts increased by almost 30% for both joint and individual filers. Phase-out amounts increased from $160,000 to $1 million for joint filers, and about $120,000 to $500,000 for other filers. So there's some fairly decent increases. Unfortunately, as I touched on before, the increased exemptions and phase-outs, though, they expire in 9 years. So those old rates, they will come back to haunt us starting in the tax year 2026. But the overall message here, if you haven't been able to use R&D credits in the past because of this individual AMT, it might be worth taking another look because you might be able to use more credits under the new law. So what has changed? We have more good news. So if you're claiming a tax credit, an R&D credit under Code Section 41, Code Section 41 itself didn't really change, but the decrease in the overall corporate tax rate, the 21%, that's going to impact the amount of credits that you'll actually realize. And I'm going to have to explain how this works. So the tax code, it doesn't allow you to take a deduction for the amount that you claim is your gross credit. That means that you have to decrease your deductions by the amount of the credit, which essentially creates additional income. So then you have to pay taxes on that addition to income. Now, since the rates are going down, that additional tax that you're going to have to pay on that addition to income, that's going to be less. So essentially you're paying less tax on the add back. Now, instead of going through this whole mechanical exercise, taxpayers, they have the option to simplify all this by electing a reduced credit under Code Section 280C. And that reduced credit is based on the maximum tax rate. And under the previous law, the maximum tax rate, it was set at 35%. And then, as I'm sure everyone's fully aware, under the new tax law, the rate is 21%. So maybe another way to think about this is to kind of flip it around, and your net R&D credit under a previous law was 65% of the gross credit, okay? And then under the new law, it would be 79% of the gross credit. So if you had 100 grand in gross credits in the past, your net credit was $65,000 if you made that reduced credit election under 280C. But now, under the new law, $100,000 in credits would net you $79,000 if you make that reduced credit election. So, a little bit of a boost that probably wasn't expected by most people, but should bump up the total amount of credit that you actually realize, so that's good news. All right, but now we're going to get into some of the not so good news. And that starts with amortization of R&D expenses. Now, we talk a lot about tax reform. Everyone loves the idea of paying less taxes, but cutting taxes also left a big, giant $1.5 trillion hole to fill, and Congress had to find a way to make up for all that lost revenue. One of the ways that they made up for all that lost revenue was this here. It was by limiting your deductions for research in future years. When we talk about deductions for research, we're talking about your research expense deductions under Code Section 174. Under the previous law, companies had the option of either expensing their research costs immediately, or they could charge them to a capital account where they would take the deductions over 5 years or longer. And the vast majority of companies that we work with, they chose the immediate expensing. Now, under the new law, you're not going to have the option to expense your research costs immediately, but all this starts in 2022. That's tax year 2022. And then starting that year, you'll be able to deduct these costs over 5 years if you're performing research in the U.S., and then 15 years if you're performing research outside the U.S. So really on one end, you have this great, fabulous R&D credit, and then on the other end, you're getting denied some of these immediate deductions that you're used to taking. So like I said before, not so good news. Overall, it's going to reduce the value of your R&D incentives under the federal tax code. But, you know, there is 5 years before it kicks in, so that gives some time for planning. And also just keep in mind that there are many lobbyists out there who are working really hard to make sure that this provision never sees the light of day. So overall, this is one of those issues that we'll have to stay tuned on. All right, and now we're on to some more not so good news, and that's with respect to orphan drug credits. So if you're a biotech that performs orphan drug research, then the big giant credits that you're used to claiming are going to be cut in half. Under the previous law, you got this phenomenal credit on 50% of your qualified orphan drug research expenses. Under the current law, you're going to get a 25% credit. Also, the previous law, it didn't allow you to make a reduced credit election under Code Section 280C that we discussed earlier. You couldn't do that for orphan credits. So you were forced to do that add back and pay the additional tax on that add back. We discussed that concept earlier. So the new law is simplifying things a bit with this by allowing you to make that reduced credit election. That's one positive you can take from this. And overall, it's still pretty good considering this is one of the items that was on the chopping block in the House bill. They wanted to completely eliminate orphan drug credits. So probably, you know, a little bit mixed in terms of overall outcome for companies that have orphan research, but not the end of the world since corporate rates are going down to 21%. All right, now we're going to move on and talk about what stayed the same. There's been a lot of questions on these two provisions in particular because both of them are fairly new and both of them are a pretty big deal for small business taxpayers. And we're going to start off here with the eligible small business credits. Eligible small business credits are available to owners of pass-through companies that can't use all their R&D credits because they're subject to the individual AMT. And the way it works is if your average revenues over the past 3 years were less than $50 million, then the AMT does not apply. And this provision, it was not changed at all in the final bill, so it's still there. Good news. And then also unchanged in the final bill was the new and very popular payroll tax credits for qualified small businesses. This one here allows you to claim up to $250,000 in credits and use them to offset your payroll taxes. But to qualify for this, you need to have less than $5 million in revenue, and you can't have any gross receipts prior to 2013 if you want to claim a credit on your 2017 tax return. This is a really big deal for startup companies and companies that are pre-revenue or just companies that don't pay any federal income tax. These companies are still paying payroll tax on their employees, and that's where they can get some relief if they qualify. So again, good news there. So that really covers all the main highlights. Overall, the final bill is a little bit of a mixed bag from an R&D perspective. There were some good things, some not so good things. If you're a small business, you're probably walking away from this pretty happy. On the other hand, I think everyone's going to have to stay tuned on the whole amortization of R&D expenses, and hopefully that's an issue that's going to get resolved in the coming years. And on this slide here, what we tried to do is just summarize some of the key developments that we went over with respect to R&D incentives and tax reform. We put them here in a nice table for your reference. I find it pretty helpful when clients are calling and asking about tax reform changes and how they might be affected when it comes to R&D credits and expensing. Also, I know that we did recently put out an article summarizing all of these same key points. We have all that in writing. It's out there, and we're happy to pass that along if anybody's interested. Please check out the contact info attached to this presentation if you have any questions, and please don't hesitate to reach out. It's been a pleasure, and thanks for listening.